The Money Show on your number one news and talk station.
Warren Ingram from Galileo Capital. Do we challenge our investments nearly enough? Do we even think about our investments nearly enough, Warren Ingram?
I think we usually fall into one of two traps. We either overthink them or we never think about them. But we never seem to strike the right balance, most of us.
Okay, so what's the difference between, what is too little and what is too much? If you're obsessing, then you start doing too much and overreacting and losing sleep, which causes irrationality. And if you're being ignorant about what's going on, well, you're not in control, are you?
Exactly. So to give you an example, I met one of your big fans today. And he said to me...
How's Dad? And what were you doing in Port Alfred?
I was having a beer.
There we go.
So he said to me, he finds it incredibly confusing. He listens to your show every single day of the week, and in 1 week, you'll have 5 different commentators, and very often with quite different views.
Yeah.
And one will be, talking about what's going on in America and interest rates going to go up at some point, and that's bad for South Africa. And then I'll come on the radio and say, I think the rand's undervalued, and it's that's going to be good for South Africa at some point. And so he sits there with this absolute information overload, not really knowing what to do.
For which I'm grateful, incidentally. I'm delighted that he's got information overload and is confused. Don't go away. Please don't go away. We need you. But I mean, you think he's confused? I've been listening to this stuff for 10 years, Warren, and you get tied up in information overload. You really do, and that's why when it comes to your investments, what sort of questions do you need to be asking yourself? You've got to be challenging yourself on a regular basis. Say, am I on the right path? Am I doing the right thing? But not to an unhealthy degree. So, what's healthy?
So let's go through a couple of ones. One. Can you count the number of investments that you have? And I'm not saying, for example, a share portfolio would be one investment. So
sure.
Not 15 shares, but one share portfolio. So can you count the number of investments that you have on one hand?
Is that a good thing?
That's a good thing.
Tick. Right.
Tick. So why is that a good thing? Well, because that means you have enough time to monitor all of them. You'll know what they are and what they're doing, and you can spend enough time understanding each of them. Whereas if you have 15 different kinds of investments, there's no chance. And most likely you're completely over diversified in your portfolio, and instead of having a good mix of ingredients in a great broth, what you've got is a mess.
And that's the trouble, isn't it? I mean, you get people who go, I've been told I have to diversify. And I mean, Julia, we need to get Julia in July, because July is the month of Julia. She's the lady that you helped when she was 27 and who's got millions invested. And I can't wait to see her again to find out how things are going. But your criticism of her was that she went a little bit mad, especially initially, and bought too many different bits and pieces.
So she's fascinating in that it's another question. I mean, so she fell into the trap of because she was an index investor, and that was what we had agreed to do. Every time a new index product came to the market, especially exchange traded funds, she was deeply tempted to buy them. She didn't buy every single one, but at some point she ended up with far too many and ended up with over diversification. So she fell into that trap of just, almost it's new and it's index and I like index. Okay, I must buy it. I mean, that's unfair because she did a bit of homework, obviously,
sure,
and didn't buy some of them. But that is the trap that we tend to fall into.
But they're also, I mean, I would love to have an honest conversation with everybody who listens to the show and say, do you understand your investments? Because I can bet you in the 90% of people probably don't understand it. They've gone to a financial advisor. They kind of like what they've been told. They've closed their eyes and signed on the dotted line and gone to church an extra Sunday every month.
Exactly. Yeah. So, I mean, I've actually asked a client once, why did you make the decision? I asked him a few years later, and he said, because you had a trustworthy face. All the stuff I'd explained to him and written, that was the depth of the conversation. So and 3 categories of products that really bug me in this space would be hedge funds, guaranteed products, structured products. These sort of black box things that we just get told a sales spiel, but we don't really understand them. And frankly, I'm not always convinced that the hedge fund managers understand their products. And the danger there is you don't know. If you don't understand the product, you don't know actually what your real risks are in the world. So you don't really know then if Bernie Madoff blows up a Ponzi scheme over there and you know, it has no impact on you. Well, if you've got a fund of hedge funds, you might have just lost, you know, 15 or 20% of your money, and you just had no idea.
I mean, one of the great questions, I suppose, that if somebody says to you, so why did you buy, I don't know, the Rainmaker Unit Trust from Ned Group Investments, or why did you buy the Coronation Top 20, or why did you buy the Old Mutual General Equity or the Alan Gray General Equity Fund? And you go, well, I saw the adverts and I really liked the campaign. You probably haven't based your decision on the best possible criteria.
100%, and I think the one trap a lot of investors worldwide fall into is you know, getting lured in by performance rankings. So the fund that was number one over the last year, it's every single time you see those rankings come out, there's no coincidence that immediately after those rankings, in the month or three thereafter, they end up getting massive new inflows of money into their fund, and that just tells me that no thought was applied to actually why investors are going in. They're simply just chasing the performance rankings, and that's really a dangerous thing to do.
But you've also not got to get married to investments or to an asset manager or to an asset management house. These asset management houses go through ebbs and flows. Some start off small, nimble and fiendishly clever, and they draw lots of investments because they win every Raging Bull award, and they are top of the heap, and they get lots of advertising budget, and they're out there, and you go in and you buy it, and so do a million other people, and they suddenly got so much money, they struggle to start investing it. It might be the right thing to leave it there. It might not be. How do we make that call?
So this is one of those where to me, patience and inaction once you've made an investment decision. So I'm not saying before you've made an investment decision, but once you've made it is very often a good decision. You know, actually doing nothing very often, most times, would be the most sensible course of action. However, let's say you've bought your general equity fund, and you bought one property fund, and you've bought one bond fund, and you've decided, I'm going to do a third, and you did that 10 years ago. What's happened now is your property fund probably makes up 70% of all of your investments, because property's done so incredibly well, and now doing nothing could become very dangerous for you. So to me, it's a case of understanding and not forgetting about your investments. It's looking at them, monitoring them, making sure that you're not overexposed to one fund or one asset class, you know, where then when the world does fall apart in that asset class, you suddenly lose a lot more money than you ever thought was possible.
So I go to a braai and there's a financial advisor with an honest face, because that is the criteria for selling financial products. And let's face it, I mean, financial advisors, I think, go to nice classes and they read Dale Carnegie until they can quote it backwards. And you've got this very comfortable investment portfolio, 3 different things. You've got a nice balance. It's all working quite well. But somebody says, why don't you just add a little bit of alpha? I love that jargon. We were talked about alpha outperformance on Monday. Add a little bit of alpha.
Yeah, bravo.
Exactly. But and it's tempting, because you've been growing at 10, 15, maybe in good years 20+% a year. But boy, wouldn't it nice to hit 20% all the time? So you get tempted, don't you?
And let's, I mean, if we go back, 5 or 7 years ago, with the launch of the exchange traded fund market in South Africa, you had a choice of probably 3. I can't remember exactly, and suddenly they started getting money as inflows from investors, and they were doing well, and then every product provider out there decided they needed to get in, but they couldn't get in just offering you exactly what was on the market already, so they had to differentiate themselves, and to the extent that they try to make themselves attractive to new investors. So this is a classic case where you meet people now who were in that market a long time ago, and they now own 34 different exchange traded funds, and that's the problem, is because it's new and someone's sold you a story, that's not really a reason to buy them. You need to understand. To me, it's a lot like cooking. You've got to say, I need a certain number of ingredients, not too many, not too few, and just the right mix of them, and make sure that could be 3 ingredients, or it could be 7, but it can't be 20. That's not possible. The
Jamie Oliver of personal finance, Warren Ingram from Galileo Capital. Thank you. The recipe for investing success. The questions you need to ask yourself, and they're great questions, great points. The podcast will be up on our website. It'll be up on the Facebook page as well. Go and have another listen to it. There are some really good lessons coming through there this evening from that nice Mr. Ingram. Nice face.